Something is off. You can feel it before you can explain it. A quiet unease that sits in the back of your mind when you look at a grocery receipt, or when a friend mentions they got laid off from a company that just posted record profits, or when the news tells you the economy is doing fine, while your own financial reality feels like it's being stretched in directions it was never designed to go. That feeling isn't anxiety. It isn't pessimism. It's pattern recognition. And what you're picking up on is real. The global economy has entered a phase that doesn't have a clean name, yet a phase where the old signals don't mean what they used to, where the numbers say one thing and lived experience says something completely different, and where the systems we built to create stability are quietly, methodically, creating the opposite. Here's what's actually happening and why almost nobody is explaining it clearly. The map is wrong. Every economy runs on a set of measurements. Unemployment, GDP, inflation, stock market performance. These are the instruments we use to read the economy's vital signs, and for most of the 20th century, they were reasonably accurate. When unemployment fell, people felt better off. When GDP grew, standards of living generally improved. The instruments and the experience moved together. They don't anymore. In the United States, unemployment has hovered near historic lows for years. GDP has grown. Stock markets have reached record highs. By every traditional measure, the economy is healthy. And yet, surveys consistently show that a majority of people in wealthy countries feel economically insecure. Consumer confidence lags the data. Young people across developed nations are delaying homeownership, family formation, and long-term planning at rates that have no modern precedent. Something is broken in the measurement. The simplest version of the problem is this: the metrics we use to evaluate economic health were designed in a world where prosperity was more evenly distributed when it arrived. When the economy grew in the 1950s, the gains spread. Factory workers got raises. Purchasing power increased across income levels. The economic tide did, broadly, lift most boats. What's changed isn't growth. It's the distribution of what growth produces. The economy can expand, while the majority of that expansion concentrates at the top, and the headline numbers won't show it. GDP doesn't care who captures the gains. Unemployment doesn't tell you whether those jobs pay enough to live on. Stock market performance is nearly irrelevant to the roughly half of people who own little or no equity. The map is showing you a territory that no longer exists. The debt machine. There's a mechanism underneath modern economic life that rarely gets explained plainly, and it's worth understanding. For decades, across most developed economies, the response to slowing growth has been the same: lower the cost of borrowing. Cut interest rates. Make debt cheap. When debt is cheap, people borrow to buy homes, start businesses, and spend. Companies borrow to expand. Governments borrow to invest. The economy gets a jolt. It works, until it doesn't. The problem is that cheap debt has a compounding side effect. It inflates the price of assets. When borrowing costs fall, money flows toward things that hold value: real estate, stocks, commodities. Prices rise, and rising asset prices feel like prosperity. But here's the trap. Asset price inflation doesn't help everyone equally. If you already own a home, rising property values make you wealthier on paper. If you're trying to buy your first home, those same rising values are a barrier. The same mechanism that rewards existing ownership penalizes entry. This isn't a policy failure exactly, it's a structural one. Cheap money was the tool that kept economies moving for a long time, but the accumulated side effect of that tool inflated asset values, concentrated wealth. A housing market disconnected from wages is now part of the problem itself. When rates finally rose sharply in 2022 and 2023 inches response to inflation, that created its own fracture. Borrowing got expensive fast. mortgage costs doubled in some markets. Small business credit tightened. Debt that had seemed manageable at near-zero rates suddenly wasn't. And the economy, so long dependent on cheap borrowing, had to reckon with what it actually looked like without it. The answer wasn't pretty, not catastrophic, but not fine either. Inflation's second story. When inflation surged globally in 2021 and 2022, the dominant explanation was supply chain disruption. COVID had scrambled global logistics. Demand returned faster than supply could recover. Prices rose. That story is accurate as far as it goes. But it leaves out the second story. Inflation wasn't just a supply shock. It was also a structural exposure. It revealed something that had been hiding in the data for years, that the real wages of middle and lower income workers had barely moved in decades once you account for actual cost increases in housing, healthcare, and education. The official numbers showed modest wage growth. The lived reality, for a significant portion of the population, was that the things that matter most to a stable life had been getting progressively more expensive for a very long time. When broad inflation arrived, it didn't land equally. Wealthier households absorbed it. Lower-income households had no cushion. The same percentage increase in grocery prices is a minor inconvenience for one family and a genuine crisis for another. And then there's the psychological layer. Inflation doesn't just hurt economically, it erodes trust. It makes planning feel futile. It generates a kind of financial paranoia where people hoard, oversave, and pull back from spending even when conditions might rationally support it. That collective psychology becomes its own drag on economic activity. Central banks raised rates to kill the inflation. The inflation slowed. But the psychological residue, the loss of confidence in the purchasing power of money, in the reliability of systems, in the idea that financial stability is achievable through ordinary effort, that residue doesn't disappear when the CPI ticks down. The labor paradox. Here is one of the stranger features of the current moment. In many developed economies, the labor market looks tight. Unemployment is low. Job openings remain elevated. Companies complain about difficulty finding workers. And yet, workers broadly report feeling economically insecure. Wage growth, in real terms, has been inconsistent. Job quality, stability, benefits, predictability of hours has degraded in significant portions of the market, particularly in the service sector where much of the employment growth has occurred. The resolution of this paradox involves a word that doesn't get enough attention: precarity. Employment numbers don't distinguish between a full-time job with benefits and a gig economy arrangement with neither. They don't capture the experience of working two part-time jobs to approximate one full-time income. They don't reflect the growing share of work that comes with no sick leave, no retirement contribution, no path to advancement. The labor market has filled in numerically. But what filled it in large part, is a category of work that provides income without stability, and stability is the foundation of every other financial decision a person makes. You can't confidently take out a mortgage on a gig income. You can't plan a family on unpredictable hours. You can't build savings when the floor might drop at any moment. What looks like a strong labor market from a distance looks, up close, like a labor market that has been quietly restructured to transfer risk from employers to workers. The geopolitical rewiring. There's a layer to all of this that isn't psychological or domestic. It's structural and global. The global economy that produced the relative prosperity of the 1990s and 2000s was built on a particular set of assumptions. Goods would move freely across borders. Supply chains would optimize for cost efficiency. Political relationships would be stable enough to sustain long-term economic interdependence. And the United States, as the anchor of the global financial system, would maintain an order that other nations could rely on. Those assumptions are now in active revision. The US-China relationship, once the backbone of global manufacturing and trade, has fractured into strategic competition. Supply chains that were optimized over 30 years for cost efficiency are now being restructured for resilience, which means redundancy, which means expense. Friendshoring, nearshoring, industrial policy. These are the polite terms for what is actually a partial unraveling of the globalization model. This isn't inherently catastrophic. Some of it reflects legitimate security concerns and a reasonable reassessment of overdependence. But it is expensive. The efficiencies that global supply chains created didn't disappear, they're being traded for other things. And those other things cost money. Energy is the most visible version of this story. Russia's invasion of Ukraine didn't just create a humanitarian disaster, it exposed how deeply European economies had integrated Russian energy into their industrial base. The scramble to replace that energy, the price spikes, the industrial disruption, all of it added inflationary pressure on top of the post-COVID supply shock. And it accelerated a broader rethink of energy dependence that will take decades and trillions of dollars to fully resolve. We are in the early, expensive phase of rebuilding economic architecture that took generations to construct. What markets are doing and why it doesn't help. One of the most disorienting features of this moment is the persistent disconnect between financial market performance and the underlying economic experience of most people. Markets recovered from the COVID crash faster than any major crisis in modern history. They absorbed the inflation shock. They processed rate hikes. And in 2023 and 2024, driven largely by AI-related enthusiasm and the dominance of a handful of mega-cap technology companies, stock markets continued climbing. This is either a sign that markets are correctly pricing future productivity gains, or it's a sign that markets have become partially detached from economic reality, sustained by the same concentration dynamics that distort the broader economy, a small number of enormously profitable companies pulling the averages up, while the median experience is something quite different. Probably it's some of both. The honest answer is that nobody knows with certainty. The AI productivity story could prove out. The concentration at the top of the market could resolve through genuine earnings growth. Or the gap between valuations and underlying fundamentals could eventually close, as it always has historically in one of those fast, brutal corrections that everyone sees coming and nobody times correctly. What we can say is this: markets are not a measure of economic well-being. They are a measure of the expected future profitability of publicly traded companies, weighted enormously toward the largest ones. When markets are up and your financial situation feels fragile, that's not a contradiction. It's the same distribution problem showing up in a different place. What to do with uncertainty? So what does someone actually do with this? The honest answer is that there are no clean prescriptions for a moment of structural transition. The economy isn't broken in a way that has an obvious fix. It's mid-rewire. Old models are losing explanatory power. New models haven't proven themselves yet. The geopolitical order is in flux. Technology is accelerating in ways that will reshape labor markets but hasn't fully done so yet. And the debt dynamics accumulated over decades will constrain policy options for years. What history does suggest is this: periods of structural transition produce both disruption and opportunity, often at the same time. The disruption tends to be visible and immediate. The opportunity tends to be structural and slow. The people who navigate these periods best are usually those who resist the twin temptations of panic and complacency, who don't convince themselves that everything is fine when it isn't, and don't convince themselves that everything is falling apart when it isn't doing that either. The feeling that the global economy is wrong right now isn't irrational. It's reading something real. What it's reading is a set of transitions that are genuinely uncomfortable and genuinely consequential. The map is being redrawn. And that always feels disorienting from inside the territory. The question isn't whether the transition is real, it is. The question is what it's transitioning toward, and that part isn't written yet.